Good morning. I figured I would drop in and just give a little update about what's going on and what I'm working on right now. So, as you can see from this chart, I believe the last time we talked, we were testing this 200-day moving average. So, we can see it's nice looking at this stuff, in the past. We can see that it tested it twice and it was successful, and then it bounced back up from here. The second thing was that we were not going to make any decisions until we got past the green line. So as you can see here, we passed the green line. It went back into that range between the green line, which is the 20-day exponential moving average, and the red line, which is the 50-day exponential moving average. And it basically skyrocketed from there. And the third thing that I look at is this green line passing the red line. So we see that it is getting ready to do that. And finally, just kind of staying above this green line so that it does an action like this or an action like this. All right. So we're not sure exactly why. They talked about, the Japanese carry trade and so on. Later on, we'll find out that, some big company somewhere probably blew up or they had some margin calls. But the reason why we couldn't really stay here was because of rates. So it is expected that rates will continue to fall, and I will show you that shortly. Rates do have somewhat of an impact on a rising stock market. Lower rates means that companies can borrow money cheaper, which means that they can increase profits, and the price of a company is not based on how much profit it has made in the past, but is more based on the forecast of how much profit it will make in the future. The market looks at everything from a futuristic point of view. What does it look like down the line? Unfortunately for me, I only deal with what is. I don't try to predict anything. I just kind of follow what's been happening. So this week the Fed is supposed to meet at Jackson Hole, discuss some stuff, and the outlook really is that stocks are going to rise. By how much, that is the question. We already have a high right here. We dropped, right? For some people, they moved out of whatever they were in that dropped into something else on a rise. There's some people that like to do that. They like to move from one stock to another or one ETF to another. A long time ago, I realized that my position is to buy the worst house in the best neighborhood, right? So quality is important, and for me, I can deal with the ups and downs of a quality instrument such as QQQ. As long as I have the cash available to purchase on, when it goes down a little bit too much, then I'm fine. In this case, it went down and up so quickly that I didn't have a need to add anything. This was just a matter of a couple of weeks. Once it crossed this green line, I'll show you my percentage was maybe about 25%. There was no need for me to do anything but to watch it go back up. Right. So rates. So let's take a look at the current rates right now. So you'll see that rates have dropped significantly. Only a few weeks ago, all of these CD rates were over 5%. I'll show you in my account that I had a 1-year CD that was 5.4%. Now they're offering these CDs at a 4.7%. Okay. The only thing, and I only look at this area, I only look at the treasuries and the CDs from 3 months to a year. That's all I look at. You'll see that the only one that's over 5% right now is this 3-month treasury. And that's because the government has a lot more control over the closer months and the pricing of the treasuries than they do for the further months and everything else. All right. So, as an example, if I switch over to my portfolio, you'll see that just in June, 2 months ago, I bought a 5.4% CD from Goldman Sachs. This CD is callable, so I would expect to have Goldman Sachs knocking at my door asking for their CD back and paying me out up until that point. I expect that to happen. If I look at this MVRXX, which is a cash account, the 7-day current yield is 5.18%. If you go back to other videos, you'll see it was a lot more than that. It may have been 5.3, so on. So the expectation is that all of these yields will come down to match what's going to happen with interest rates. So those great interest rates that we've had for a long time, eventually they'll probably come back down to maybe about 3%. So it's only a matter of time, So where does that leave me? That leaves me in either just buying these near month treasuries for as long as I can, just continuing to do that because I know that the interest rates are going to continue going down. The second thing that I can do here is that, as I said before, as rates go down, the market tends to go up. So my expectation is that this and this will go up. Right now my allocation is 30% here and 3% here. I have set targets of about 36% for the TQQQ and 5% for the UPRO. If it hits over 8% here, I start to cut. Over 36, I start to cut. And that is basically how I'm going to play it. So finally, if I look at the performance, all right, year to date, this is kind of where we're looking at. Up for the month 1.33%, NASDAQ 100 2.09%, for the year 1649 versus 1748, and as it goes up, I expect it to rise a little faster, since TQQQ is a 3 times leverage instrument, and I should be getting some more cash as well. If I take a look at the estimated income here, there's more cash that's going to be coming in on a monthly basis. So 9.1, so basically $7. And I know this number looks a little small, but just remember that this is a small account being traded here. So $7 on that, is a fair amount of money. Okay, so that is all I have for today. The bottom line is rates are dropping, markets are rising. I'm going to stay disciplined and quality, and that's how I plan to play, the next few weeks. So that's it. Have a great day.